Hi, everybody. Thanks for joining us tonight. We've got a really great program for you. It's called The Costs and Economic Opportunities of Climate Change. And our speaker tonight has been at the forefront of business and sustainability for the last 25 years. He's a senior lecturer and business sustainability outreach director at the Nelson Institute for Environmental Studies. He teaches classes at the Wisconsin School of Business and is a founder of the Wisconsin Sustainable Business Council. He's also founder of the nonprofit Wisconsin Microfinance, which provides access to capital to those living in areas where such funds are severely limited. Actually, he is, and he's just retired. He's talking to me about that a little bit. But anyway, let's welcome Tom Eggert.
Well, thank you. Thank you for the invitation to speak. I'm going to share my screen. When the invitation came to talk, I had just agreed and thought, this would be a nice opportunity to talk about some of the economics around climate change. But then quite fortuitously, there was a major study that was published last month that makes giving this talk so much easier. So the first part of the talk will be just going through the results of that study and what they found. This was a McKinsey & Company study. McKinsey being one of the sort of the leading consulting groups in the country, if not the world, and being known for doing very in-depth, very credible research on topics. And then we'll transition and I'll talk about the opportunities part of what the study talks about and sort of how do we translate those opportunities to each of us and what are those opportunities. So I'm going to do I'm going to start. I think I can do this. All right, so away we go. So this is a study. It's called the Net Zero Transition, just published a couple of weeks ago, actually, mid-January by McKinsey Global Institute. And the subtitle is What It Would Cost and What It Could Bring. And so that's what we're going to talk about. So the conclusion of the study was some big numbers. It's going to cost us $9.2 trillion a year, every year between now and 2050, which is daunting. And the rest of my presentation is going to talk about how do we think about that 9.2 trillion, because clearly that's probably not obtainable as it's presented. So, McKinsey & Company, again, a very credible organization saying, what's it going to cost to get to net zero by 2050? 9.2 trillion a year. So that's 275 trillion worth of investments. When you multiply that 9.2 times the number of years between now and 2050, you get 275 trillion. That's a big number. It's a big number even for us in the U.S., not let alone some of the developing world that is going to pay a very heavy price. Before I go further, I do want to invite questions as we go along. If there are questions on, sort of what I said, if you just didn't understand, if there are broader questions about what does this mean or what could we do, let's save those to the end. But if there's a clarifying question, post it in the chat and I should see it and we should be able to get to it. Okay, so we're talking about big numbers. Relative to the size of the global economy, 6 to 9% of global economic output would be devoted to getting to net zero. Again, really big numbers. But the closer one looks, the smaller the numbers become, making that challenge of addressing climate change much more of a global opportunity. And what do they mean by that? The 9.2 trillion figure includes total annual investments, lumping current and new spending together. So what do we currently spend? Well, now we're spending around 3.7 trillion per year on what McKinsey calls high emissions assets, fossil fuel extraction, refining, gasoline powered vehicle production, power generation, cement and steel production, those kinds of things. So if we take about one of those 3.7 trillion and shift it to low emissions assets like renewable power generation, electric vehicles, building electrification, that's money that's already being spent that we're just redirecting. So that trillion would be on top of the 2 trillion that the world already spends today on on such clean and lean technologies and supporting infrastructure. Was there a question? Okay, so already we brought that 9.5 down to 3, right? So we took 1 trillion from money that's already being spent that would be redirected, and then 2 trillion that's already currently being spent. So now that 9.5 becomes 6.5. So we're making progress. So that then puts the truly new spending at only 3.5 trillion per year, but even that's an overestimate of the additional spending required to get to net zero. So we have on the left, that's the what's left of that 3.5 trillion that's being spent on current high CO2 spending. So you can see that it's 2.5 trillion there. We've moved 1 trillion of that to that third column, the high CO2 reallocated to low CO2, and we are spending currently $2 trillion. So what do we need then? What's left is the 3.5 trillion that we're still looking for where that money is going to come from. So McKinsey's estimates are based on climate scenarios developed by this group of central banks and monetary authorities. They call it the Network for Green the Financial System. So this, again, a very credible source of information, central banks around the world. So net zero by 2050 envisions an additional 3.5 trillion in annual spending, and looking at that in comparison to current policies. Those policies envision additional investments, mostly, though not exclusively, on low carbon assets. All told, the difference between current policies and net zero by 2050 is only 25 trillion in total spending over the next 30 years, or less than an extra 1 trillion per year on average. So again, these numbers are getting much more reasonable. Current policies would cost 250 trillion by 2050. So again, what we already are doing, what already is in the books, it's already baked in. We have committed to spending 250 trillion by 2050. A net zero scenario costs us 9% more. And that 9% more, as we're going to see, is kind of front loaded as opposed to rear loaded. So the net zero path ramps up spending this decade, reaching an annual peak of around 10 trillion in the 2030s before falling again. Current policy scenario assumes a much slower ramp up, reaching its peak by 2050. So, if we do nothing, current policy scenario assumes this slower ramp up to 2050. What we're doing is front loading that and potentially spending more upfront. So essentially what I just said, the net zero path front loads investments. The reason is why this person, Saul Griffith, describes the shift from fuels to capital. Upfront investments, front loading this investment saves on fuel costs later on. Fuel costs what we're trying to do is minimize carbon fuels, natural, sort of fossil fuels that are carbon based. And by shifting the fuels earlier in the process, spending more, we save on those fuel costs later on. Makes sense, right? So if I buy an electric vehicle, I spend more for the electric vehicle, but my maintenance costs, my operating costs are reduced because I'm not putting gas in it every week or however often I would be putting gas in a car. And the electricity that I'm putting in it is far cheaper than gas, and people with electric vehicles can confirm that. Okay, so we're still, what we've gotten to up to this point is we're still talking about spending a bunch of money, but let's think about this. Savings do not include the value of saving the planet by reducing climate risks. So another recently published report said last year, 2021, weather and climate related economic losses were $330 billion in 1 year, in 2021. Yes, that was the third costliest year on record after adjusting for inflation, but by spending this money, reducing our carbon footprint, working towards net zero by 2050, we're going to start reducing the amount of money that is spent on weather and climate related economic losses. So $330 billion in a year only takes 3 years and you're up to another trillion, right? So these are savings that aren't included in that money that we're spending, but are savings nonetheless. So overall, global climate damages exceed the cost of action, McKinsey's conclusion, justifying limiting temperatures to 1.5 C through pure economic reasoning. So if you were just looking at what are the costs of climate damages, we could economically justify spending money. We would not only economically justify, we'd be money ahead. We would come out ahead by spending money to offset those damages. Comparing costs now with benefits later is the political stumbling block of the low carbon, high efficiency transition. The problem is someone does indeed need to spend the money now, and getting consensus to spend money now when you could be putting it off and spending it in the future is hard. So we've got a senior research scholar at Columbia argues that there are 3 sources of money for this clean energy, for this carbon, for this net zero transition. And this makes sense, right? Ratepayers, taxpayers, and shareholders. That's where the money is going to come from. Of that, those trillions of dollars that are going to be spent, that's where it's coming from. Ratepayers, taxpayers, and shareholders. It's the decision point amongst those that begins to get really hard. Passing increased energy costs on to consumers implies that ratepayers foot the bill. The alternative is to have either governments in the form of, paying tax dollars, so ultimately coming from taxpayers, or shareholders step in to pay. And this is where we don't have agreement on who should be paying for what. And this is the crux of the problem. If there are only 3 possible groups that could pay, ratepayers, shareholders, or taxpayers, how do we make the decision between those 3? McKinsey report makes it clear that the benefits of a low carbon future are well worth the fight, well worth getting to agreement, well worth trying to figure out what is the answer to the, to who pays. So I'll argue that the transition will arise from more investment, and that investment could come from ratepayers, shareholders, or the government, and it will produce more economic growth, more jobs, to say nothing of a more livable planet and, cooler, newer, better, really interesting technologies. So now I'm speaking. I believe that we're teetering on the edge of this next revolution. Perhaps it's called the information revolution or the advanced technology revolution, but we're in for this. This is a huge transition time for us as a society, us as a world. Who profits from that transition? Well, not surprisingly, some businesses will develop new clean technologies, and some will go the way of businesses that made film cameras or 8-tracks or beta recorders, and they went away. Although beta recorders was Sony, and Sony didn't go away, but beta recorders went away. The winners will enrich their shareholders. And what do we know about who those winners might be? So I don't think there's too many of us. Let me open up the opportunity. So unmute yourself. What are some of the key areas that there is going to be, sort of innovation, cool things happening? I already mentioned, sort of the transportation sector with the movement towards electric cars. Others have ideas on what other key areas there's going to be change in?
The blonde, apparently probably blue-eyed German women, right? So this idea that they're predators, that Jews are predators or parasites of different types. And if Jewish blood continues to contaminate German blood, it's going to continually bring down.
Jim, do you have a point that you're making here?
That they want to make time and time again. And again,
Jim,
that they have to do this special issue where they say,
Jim, do you have a point? I guess not. All right. Well, so it's always hard on Zoom. It's much easier in a classroom. You can just stare at students until they actually feel like they have to say something. So we can seek to invest in these key areas, sort of thematic investing. So I'm going to run through some of those. You can do thematic investment options with individual stocks where you're hoping that you're going to pick the winner. Again, let's focus on the electric vehicle area. For those that pick Tesla, they have made a ton of money, right? Tesla is up probably over 100 times from what it traded at 5 years ago. But it's hard to pick the individual stocks, who's going to be the winner. So they've introduced this idea of exchange traded funds, which are like mutual funds, but with exchange traded funds, you can invest in an area. So you can invest in electric vehicles, and the exchange traded fund, the ETF, will buy all the stocks of companies that are making electric vehicles. And then regardless of who the winner is, you're gonna win because they're part of your portfolio. So here's some investment themes that represent ways for you as a potential investor to profit while addressing impacts of climate change. So again, what we're saying is there are going to be winners. The solution to many of these climate problems, yes, government may fund parts of it, but it will be businesses that will be implementing or coming up with these solutions and then implementing them. Those businesses are going to do well. How do we pick those businesses? How do we pick the areas that those businesses are in? So that's kind of really what I'm talking about now. So transportation, the electric vehicle example. There's 1, 2, 3, here's 5 ETFs. And pay attention to the trading symbols of these ETFs. So the first one goes under drive. Second one goes under e-car. Third one is cars. Fourth one is moto. And then the fifth one is iDrive. So if you would, go into your Schwab account, your Fidelity account, your Vanguard account, you could enter those symbols or go to your investment advisor and say, geez, I'd like some information about these. So I provided 1 year and 3 year performance numbers for each of these. So for instance, the first one, Drive, up 9.4% last year. Not a good year as compared to the S&P 500 that was up probably twice, almost twice that last year. But over the last 3 years, up 123%. Or we look at e-car, up 5.3% last year, 99% over the last 3 years. Or cars, up 4.7% last year, but 132% over the last 3 years. And you can, sort of go down through the other ones. So the argument that I'm making is that pick an area, and we'll go through some other areas that you feel strongly about, that this transportation sector, this represents the transition of fossil fuel-based cars to electric cars. And if you believe that that transition is going to take place, in fact, it probably has to take place, but if you believe that it's going to take place in the near term, because you don't want to lose money for the first 5 years before things take off, then picking out one of these ETFs, and there are far more than this available. I just picked out some example ones, and saying, I'm going to put a small amount of my money and invest in the future because I believe that climate change is sort of the topic of the of the next decade, and we have to make progress over this next decade. And in the transportation sector, I think the electrification of the fleet is going to be one area that we're going to do that. And I want to profit as that transition takes place, and potentially you can profit through one or more of these ETFs. So what are some other areas? Here's demand for electric cars are seen accelerating. So this is over the last 6 years. It's going up everywhere. It's going up, sort of quickly in China, where there's a lot of movement to cars, and Europe has, not surprisingly, is ahead of us, and then we fall kind of behind that. Other thematic energy generation. So we've got 5 ETFs here also. A U.S. carbon transition readiness ETF, up 7.36% last year, and it's too new to have a 3-year performance. Global X Renewable. Global X is the name of the sort of the company that hosts this. Renewable energy producers, trading under the RNRG symbol. Not a good year for this, or you can see for the rest of these last year. But if this transition is taking place, is this an area that you would want to bet that the energy generation sector is going to be a sector that's going to profit from this transition, from this climate transition. So RNRG was up 24% over the last 3 years. Invesco Solar. So this is purely focused on just solar companies. Not a good year last year, but over the last 3 years, up 182%. The equivalent to that is FAN, the wind ETF. Much better last year, although still a loser, but not nearly as successful over the last 3 years. And then a general clean energy ETF that was, had a bad year last year, but up almost 100% over the last 3 years. What else could we invest in? Well, how about batteries? Lithium ion batteries that are going to power those electric vehicles are, sort of the linchpin for the success of electric vehicles. Tesla's been struggling with batteries. Other companies are trying to figure out what is the technology we're going to use. We've settled on lithium ion for the time being. Is that going to be the long-term answer? Where are we getting the lithium from? How do we recycle it? These are all questions that need to be answered. So there are I can only find 2 ETFs in the battery area. The first one had a good year last year, outperformed the S&P 500, has had a great last 3 years. And not surprisingly, as we've transitioned most of our batteries to lithium ion batteries. If you have got a laptop, you've got a lithium ion battery. If you've got a smartphone, you've got a lithium ion battery. And the electric vehicles that we're talking about, whether those are cars or trucks or buses, are all being talked about as lithium ion battery companies. Then the second one didn't have as good of last year and didn't have as good of last 3 years, but still, sort of, adequate performance. What else? Well, smart technology. We've been told that the grid is going to have to get a lot smarter. We're going to have smarter technology in our houses. Our TVs are smart now. Our refrigerators are going to be getting smart. Our, we can create smart houses. So an ETF that is in that smart grid infrastructure did well last year. This is grid I'm talking about. So it was up 27.6%, outperformed the S&P 500, and then had a great last 3 years, up 171%. So this is looking at grid infrastructure. How do we make our grid smarter so that those smart appliances, smart technology that we have in our houses can be accessed through the grid. Second one is the intelligent structures, same ideas, smart infrastructure. Not as good a year last year, up 9%, and then the last 3 years up 91, almost 92%. What else? Well, buildings and building materials. We know that buildings are responsible for 30+% of the carbon footprint of, Madison, of Waunakee, of Wisconsin, whatever, whatever boundaries we're going to draw. Buildings are responsible for a huge percent of carbon. Heating buildings, the electricity used in electricity used in buildings, and then just building construction. So you've got a number of ETFs that are focused in the building sector. Dynamic Building and Construction ETF goes by under the symbol PKB. Last year, good year, outperformed the S&P 500. Last 3 years really has done very well. You've got the Home Builders ETF, very good year last year, even better performance over the last 3 years. And then a U.S. Home Construction ETF, again, great year last year, even better for the last 3 years. So we know there's going to be a lot of construction. We know that whether we're talking retrofits or new buildings that become much more energy efficient, that is one of the keys for making progress towards a net zero future. Commodities in general. So these are the sort of the building blocks, and it could be agricultural commodities. It could be sort of physical commodities for building buildings, building bridges, building highways, those kinds of things. So commodities as the building blocks for this transition. And also, I think a good bet because of the infrastructure bill that was recently passed. First one in Invesco Optimum Yield Diversified Commodity Strategy had a very good year last year, outperformed the S&P 500, haven't been around for 3 years, so they don't have a 3-year performance. And then some other, sort of comparable. iShares has a commodity dynamic roll strategy ETF. There's the performance numbers there. And then the standard Bloomberg all commodity strategy, which is a much broader strategy. You can see all of these had good years last year, much better performance than last year than over the last 3 years. Carbon, which is sort of like a commodity, you can now trade carbon through an ETF, and in fact, you can make a lot of money in these ETFs. So the first one goes under the symbol GRN, up 147% last year, up 208% over the last 3 years. And then the Crane Shares Global Carbon ETF, up 107% last year and 133.9% over the last 3 years. So who'd have thought of, all of the, sort of the carbon that is being marketed, where companies are looking for carbon offsets that they can buy, and there's a price on carbon in Europe and in other other parts of the developed world, including China now. There just isn't in the U.S. Carbon has a value, and that value, I would think, is likely to increase over time as we make it more difficult for companies and countries to emit high levels of carbon. So it's kind of a bet on, do you believe that the future is going to involve some sort of cap and trade, system as it does in other places where carbon is priced. And so this is a way to bet on the fact that carbon is going to be priced at some point in the future. And then finally, food systems transition. Food is responsible for a huge part of our carbon footprint. Also, our food systems will need to transition in order to reduce that carbon footprint, in order to make progress towards that net zero by 2050 goal. So what are some of the ETFs? Ag Tech and Food Innovation ETF goes under the acronym or under the trading symbol of CROP. Didn't have a good year last year, but I think is an interesting play in this field. Global Agricultural Producers ETF, reasonably good year last year, not quite as well as the S&P 500, and then sort of average over the last 3 years. Notice that it trades under the veggie symbol. And then this evolved U.S. consumer staples, and consumer staples are things that we have to buy regardless of inflation. Up a reasonable amount last year, and then 62% over time. So I mentioned this earlier. The last time of great change was post World War II. We went through a huge transition at that point. Growth of the middle class, significant change in our technology and workforce and those kinds of things. I'm going to argue we now enter an era where great change is equally likely to take place. Most commentators feel that it's the millennials and the Gen Xers that are going to lead this change. I think there's good reason to think that is going to be the case. And if that change is going to take place, let's learn from the millennials and where they're investing, what they're investing in, and not surprisingly, ETFs are a millennial favorite. I hesitated to quote Mark Zuckerberg, given sort of what's happened with Facebook, Meta, recently with their stock price collapsing by probably almost 30% now. But he says, the biggest risk is not taking any risk. In a world that is changing quickly, the only strategy that is guaranteed to fail is not taking risks. And I would argue from an investment perspective, this quote is equally applicable. So thank you for the opportunity to chat with you. I'm going to unshare my screen, and hopefully there's enough there that we can have a conversation. I couldn't possibly have answered everybody's questions.
It looks like Kathy has a question in the chat.
Yeah, great question, Kathy. Mutual funds haven't caught up to ETFs quite yet, and so there are not a ton of thematic mutual funds. The examples that you use, wind, there is not a thematic wind mutual fund. Solar, there's not a thematic solar mutual fund. There's arguably some thematic energy mutual funds, although trying to get them to focus really on clean energy is hard. ETFs function just like mutual funds, except that they're tradable during the day. Mutual funds are only tradable at the end of the day. And so this evolution of, sort of investing in a portfolio of companies that mutual funds introduced, 40, 50 years ago, now one of the limitations of that was that you could only enter or leave a mutual fund at the price set at the end of the day, whereas ETFs you can trade throughout the day, but they are set up exactly the same way. In fact, many mutual funds have ETF equivalents, and I haven't talked about those, but looking for thematic ways to invest, ETFs are far ahead of mutual funds.
Any other questions for Tom? It's he's covered so much and so well that maybe maybe you had your questions answered. But if there's anything, you know, you can.
So there was a question in the chat just about where somebody could, because there's a lot of information, especially in the investment options. Will this be the recorded version will be posted through the library?
Yes, it will. It's on our YouTube page. And how you get to that is by going to our website and going under programs. That will take you to virtual programs and to videos. It's we're going to kind of revamp our getting to our programs in future on our website, but right now that's the maneuvering you need to do. So if you just go to programs, it'll get you there. And that's wannakeeppubliclibrary.org. Oh, looks like there's another question here.
Yeah. So do we rely more heavily on business to help us have a meaningful conversation? That's a great question. You know, certainly business is interested in, you know, from the credentials that were read about in as part of my introduction, this is an area that I've lived in for the last 30 years. Originally, when I started teaching in the sustainability space, it was under the Clinton administration, and Clinton had created the President's Council on Sustainable Development. And arguably, that was the last leadership that the US showed in the sustainable development area until the Obama administration. So with a complete lack of federal leadership on the question of sustainability, it was left to others then to sort of step into that leadership role. And originally it was, you know, sort of Patagonias of the world, or the Ben & Jerry's, or the Toms of Maine, or kind of the, you know, those iconic companies that we think of as just kind of different. The Body Shop would be in there also. And that was the beginning point. But then you started this evolution of more and more companies figuring that there were a number of drivers that were driving them to embrace sustainability. Certainly customers was one, but investors was also equally important. And interestingly, employees, especially the young people that were leaving, you know, sort of the university and entering the workforce, survey-wise, they said, I want to work for a company where I believe that my company is making a difference, and I want to feel like I'm part of making that difference. And so if you wanted to attract the best and brightest, you needed to be able to tell a story about how your company was making a difference in the world. And, you know, this is stark contrast to 20 years ago, where if you wanted to attract the best and brightest, you offered more than, you know, than your competitors. And it wasn't salary that was driving decisions for employees on where they were going to go to work. And so, those three drivers, customers, investors, employees, and to a lesser extent, governments played a slight role, got business very interested in leading on sustainability. And climate was, I guess is the most recent manifestation of that. But there's still a lot happening in the water area and the waste area and other air emissions areas. Business doesn't care about the politics of climate change. They care about their supply chain interruptions. So if weather is going to cause changes in their access to raw materials that they need, that's something that is a risk to them, and they need to sort of be on top of that and position themselves to adjust to that risk, even if it is caused by climate. So if they can do something to minimize that risk, that's in business's best interest. Customer interests, customer demands are changing. More and more of us are asking about the environmental or sustainability credentials of products or services that we are purchasing, which is causing businesses to respond to those. So I don't want to get too optimistic about business. I think it's important to be realistic. Business is still interested in selling stuff into the market that people are going to buy. The more that we can, it's the vote with your dollar kind of ideology. The more that we can purchase things that say, I want you to make more of these kinds of things because these are the kinds of things I'm interested in. And we saw, the best example ever was just the explosion of interest in organic produce. Most of you can remember a time when the grocery store had no organic produce. And why are there huge sections in almost all grocery stores now of organic produce? It's because people not only said that they wanted organic produce, but they bought it. And the more they bought, the bigger the areas got. And so, grocery stores responded to demand just as any other business responds to the demands of their customers. So again, if we want more of something, if we want more green energy, send your signal into your utility provider that I want more green energy. And if that means, paying an extra couple cents to get, your energy being green, because MG&E offers that option. MG&E also offers the option to purchase solar panels that then produce the electricity that you're using. You can do that. And, the more people do that, the more capacity that MG&E will produce. But on the flip side, if it's just lip service, if we just say, oh, geez, I'm really concerned about, sort of growing carbon emissions, but that's as far as it goes, that we don't do anything about it, then business isn't going to do anything about it either. It's not until sort of talk meets action that you start seeing changes within the business community. And in this political environment, having business being okay with, the government positioning itself on climate change makes it far more likely that the government will do something on climate change than if business says, no, that's not an area that that we should be concerned about. So the question was, is the economic interest of business in doing what business does likely to bring about change in this broader sustainability space, and in particular in this carbon and climate space? I'd argue yes. And we have seen lots of examples where business leadership, because of the demands because of the drivers that are placed on business, where they've been very progressive. I mean, we've got all of our utilities in the state now committed to net zero goals in the future. That's only a very recent a very recent change amongst our utilities, because in the past that had been too expensive for them to envision a way there. Now they have to envision a way there.
I have a question about the packaging. Everything is packaged.
Mhm.
How do you see those businesses going into a new realm?
Well, I wouldn't be investing in packaging businesses. So that would be, the first thing. I do think there is an overall trend towards minimizing packaging. I mean, most of us can remember when we bought deodorant in the store and it came in a box and you had to take it out of the box and before you got to the deodorant. Those boxes are gone. And that's, emblematic of a lot of packaging that no longer is being used. However, are we still over packaging an awful lot of stuff? Yes. Sort of the pandemic, I think, led even more of us to purchase stuff online. And that, comes in a box, and then in that box, there's a box, and in that box, there's a box, and then there's some wrapping around it inside that. So I don't know that the pandemic and our shopping habits because of the pandemic have resulted in less packaging. But I do think that's a trend overall that we are actually making good progress in, even though there might have been a setback with all of us purchasing online over the last couple of years.
I see a lot of people thanking you, Tom. Are there any other questions? It looks like there's one from Lynn.
So do I think changing our investment strategies and buying habits will be swift enough to implement real change? No, but I do think it is a part of the overall sort of changes in society that will lead to real change. It's the Greta Thunbergs of the world. It's the young people, sort of stepping up. It's customers. It's employees. Saying this is important to me. It is people running for office and asking our politicians to do things differently. I think there isn't a silver bullet. There's maybe silver buckshot, but investment strategies is part of an overall plan or an overall approach, and not the sort of the answer in and of itself. Good question. The flip side of that, and I mean, let me restate what I stated, is that you can still make some money. So, and who's against making money? Sort of backing some of these companies that are leading on, sort of this movement to net zero. By investing in them, we're encouraging them to do more of what they're doing. And also we're riding along in their coattails as they do good things. And somebody's got to make some money on it. So why not us?
Are there any further questions? Well, if not, perhaps we'll wrap it up there. And thank you very much, Tom. I learned a lot, and I think everybody else probably did too. And it's something to carry with us and tell others this sort of information. This program is part of a series that's going to be a Zoom series at Wanakee Public Library, and it's called Sustainable Ideas in Action. Our next program will be on March 3rd, and it will address the apparel industry and all of the many facets of that industry that kind of come into being one of the products that's most connected to climate change. And it is called Sustainability in the Textile and Apparel Industry from Corporate to Grassroots. And our speaker is a New York apparel designer who has been involved in both and is involved in both. So that'll be interesting. So maybe we'll see you all then. And again, thank you very much, Tom.
Thank you all for this opportunity to talk with you, and hopefully I've given you some things to think about. That's the ultimate goal of any of these. So thank you. Have a good night.
Good night, everybody.